Hey, this is Kevin Gormley, a CPA that does financial planning, and today I'm going to talk about first quarter 2016 leading edge financial planning. Charlie and I want to have more information for clients. That's really part of our goal. And so one of the things that we're going to do is every quarter just give you the actual documentation as well as a little discussion around what happened in the quarter. Now, the most important thing I can tell you what this is not looking at short-term performance. This is not looking at performance chasing. Sometimes numbers are the worst things in the world because they can make you think you're smarter than you are, or make you get rid of the plan you currently have to go for the plan that seems to be working better at the current time, and that's called performance chasing. What we're looking to do every quarter is just to discuss some of the things that we didn't think would come true and did come true, and some of the returns that are just kind of unexpected, to reinforce the fact that human beings cannot predict the future, and things we think are going to happen many times don't happen. And that's the reason to have an overall portfolio allocation of large, medium, and small company, international as well as U.S., as well as maybe some stocks, bonds, REITs, preferred stock, regular stock. So with that, let's go forth here. And so these were the returns in the first quarter. And I think the first learning here is that these are shocking how good the returns are. Now, 0.97 is 1%. The U.S. stock market was up 1%. Once again, and I'll show you the actual events of Q1, but there was a lot of discussion about the market crashing. Everybody was talking about, oh, the market's going to crash this year, and it did in the first quarter. And so, and I'm not predicting the market won't or will crash in the rest of the year. We simply don't know. We are short-term agnostic. But once again, if you sold out in the first quarter because of all this volatility, if you sold out, the good returns seem to show up when we least expected, and that is what happened in the first quarter. Now, international stocks were down about 2%, and one of the things that Charlie and I have talked about over the last 6 weeks is that since U.S. stock has done so well recently, it may be becoming overvalued, and international may become a greater value over time. And so although the U.S. still looks like the cleanest dirty shirt out there, it looks like the U.S. is a good market. By diversifying across the world, we really do protect ourselves from massive downturns and just get a better experience over long-term periods of time. Now, yes, the U.S. and the world can all go down at once. Not saying they can't. But again, if we look at diversification, it's the only free lunch. Emerging markets were really the shock of Q1, up almost 6%. And when I say the shock, I mean everyone at the end of last year was saying that the U.S. dollar is strong, emerging markets are in trouble, oil is a big part of emerging markets. Why the heck are they up 6%? I think this is one of the big surprises of Q1 of 2016. Global real estate up. Once again, this has U.S. and global in it, but global real estate was up. U.S. bond market was up, very strong, 3%. And I can't read what this other was, but I'm sure it was international bonds were up 4%. So when we look at this, emerging markets, global real estate, U.S. bonds all beat U.S. stocks in the first quarter. So short periods of time may be meaningless, but at least we can see that things don't always go as predicted. So this was the first quarter and the misery. We immediately started out on a downturn. The big concern here was China's market. They were crashing their own currency. We wouldn't probably use that terminology on TV, but that's what they were doing. Oil was to a 12-year low in January. The Dow, the S&P were off to the worst start of any year in history. Iran sanctions end, and they're supposed to flood the market with oil. And then Bank of Japan, to make people even more depressed, went with negative rates. And so more negative stuff happened, but for some reason And maybe we don't even know the U.S. market turned positive sometime in March and had a positive return. Here's the world market. It didn't crash in the beginning of the year. I don't know why this says March 2015. I guess, oh yeah, this is March 2015. So this is the start of the year here. Before they just went January, February, March. This was the start of the year. So the world market again started here and went down and then finished up and just missed being really strong. The world asset classes, REITs did the best. REITs are real estate investment trusts, in case you don't know. World REITs did really well. U.S. REITs did okay. And then you have the emerging markets, value, which is the companies that are the cheaper companies, the companies that have the lower price to book. And then we have regular emerging markets. The U.S. REITs, like we said, were up. They were actually up 5%. I didn't even know they were up that much until seeing this number. The bond index, again, people were saying bonds would crash as interest rates go up. It was up 3%. And I'm going to send the slides. You can look at the rest. U.S. stocks, the way that Charlie and I think about equities, and the reason why Leading Edge Financial Planning thinks about it this way is because the evidence-based research says that you should subdivide all the markets and have growth and value and large and small. And so that's the reason why you're seeing differences here. In Q1, value really was the dominant player. And when I say dominant, I mean the numbers aren't that big in between. But small cap value, which are the smallest companies that are publicly traded, and value means the ones that are the least expensive. Sometimes they're dog companies. No one wants to own them, and that's why they're the least expensive. The companies that were the worst performers in Q1 were the glamour companies, the high flyers, the ones that have done so well recently. Small cap growth, and small cap didn't do very well either. Large cap growth, which are the larger companies that grow fast, did okay. International developed across the board. What we see here is that large cap value, large cap growth, pretty much everything was down. And I'm going to pause it 1 second here. So now we can see that the gray is local currency. So if you bought these international stocks in foreign markets, you can see how much they were down. But because the dollar actually weakened a little bit in Q1, you can see that they weren't down as much for people that owned international stocks that lived in the U.S. and were buying in dollars. And small cap actually had a little positive. Emerging markets, again, the huge performer, again in dollar terms, which is the dark gray. Value, emerging market value companies, the ones that were on sale, did the best. And the small companies in emerging markets did the worst. And that's 10% of the world capitalization is in emerging markets. As far as countries go, I'll let you take a look at this. These are both the developed on the left side, emerging market on the right. Canada, New Zealand, Singapore, Netherlands, Australia, Norway, Portugal, and then U.S., Sweden, and France were all positive. All the other developed countries were negative. And again, almost all the emerging market companies were positive. And Brazil has been going, there's been a sort of coup, an impeachment in Brazil right now, and yet the market was up 20-something%. That's kind of crazy. Russia, even with oil being down in price, Russia and South Africa both did extremely well. Real estate investment trusts. Global did better than U.S., but hey, I'll take these returns all day long. Of the REIT market, 59% of the REIT market are in the USA, which are publicly traded real estate, and the other 41% is in the rest of the world. Commodities, real tough time. Natural gas was the worst. Natural gas is so cheap, and it's a lot cleaner than coal, and we just have so much of it. It's a waste product, and we just have so much of it. It's fantastic that it's low in price. Hopefully our heating bills will go down. And then fixed income, here's the returns across the different bonds. 10-year Treasury, this is actually the yield, I should have said. It's yielding 1.78%. State and local municipalities 3.38, and then AAA corporate and A to triple B corporates, and these are all 10 years. You can see what the yields are. And again, most of these were a little bit positive in the quarter. We believe in global diversification. Okay, we believe in investing in all countries. It doesn't seem very exciting right now to invest in the world when the U.S. has done better the last number of years, but it will change again. And so on the on this chart here, you can see if you had 100% stocks, what the returns have been over the last 10 years, 75% stocks, what the returns have been. I think these kind of things are more impressive when you look at the 10-year time period. It kind of shows you what type of a portfolio would have had what type of a return. And so the two most important decisions that you make when you're building a portfolio is, number one, what percentage of stocks and bonds, and then number two, I would say, what asset classes, large, mid, small, foreign, domestic, bonds, REITs, preferred stock, what do you want to own in that portfolio? Those are really the most two important questions. So that's it for now. You can read about Dave Butler offers example how free throws is like investing, but a lot of people don't like sports analogies. So anyway, this is Kevin, a CPA that does financial planning. Thanks for watching the first quarter update.